Now, talking about NPS, it also has an equity exposure. Now, with a retirement, with a goal that is retirement, it's very important for you to invest in equity, especially if your time horizon and you've started investing on time. Equity can actually help you achieve your corpus, and if it's done in time, the investment is done in time, it can help you achieve more than that. Talking about asset allocation, NPS, how freely can we do that? What kind of asset allocation does NPS allows an investor to have?
Hi, Kavita. So I think before we go to the asset allocation, it possibly will be kind of good to recall the advantages of NPS for the viewers of the show. NPS is actually possibly world's lowest cost retirement solution, which has the government backing in terms of regulations, and it has tax advantage as well. So NPS is the only product which has separately carved out 50,000 rupees a tax exemption limit available. So technically, somebody wanting to invest in NPS can actually do so up to 2 lakh rupees in a year and gain tax exemption on their income. And that means one can actually save up to 64,000 rupees or more if one is basically belonging 30% income tax bracket. Now, advantage of NPS, as you rightly pointed out, is unlike traditional retirement products, which typically have been PPF, Public Provident Fund, and Employee Provident from EPF for salaried individuals. They typically, or they actually are only debt securities product, primarily investing in central and state government bonds. And what they do is basically, while they lock you in for a longer tenure, at least 15 years in PPF and at least 5 years in EPF, and then, or unless you change a job, technically one can actually stay invested till 60 and only has to basically be happy with inflation adjusted real return in EPF and just inflation beating returns in PPF. So what happens is you actually are not able to grow your purchasing power as you step into retirement. You actually just protect your purchasing power. So here comes NPS, which actually gives you more tax advantages than PPF. It gives you more flexibility across asset allocation. It gives you possibility of rebalancing and locking your gains, actually buying cheaper equity and multiple other things, which actually can play a very important role in growing your wealth. And when you step in retirement, it gives you an advantage of actually choosing to withdraw a large corpus at lump sum, like 60% of your entire money you can withdraw as lump sum, and 40% you can convert in deferred annuity. So that's where the advantages actually emerge as a retirement solution, unlike a fixed income investment product that PPF and EPF are, in my opinion. So it's a wonderful product because it allows investment in equity and the multiple rules governing it. We can talk about it as we progress in the show.
So, all right, so let's talk about different asset classes that NPS as an investment tool has to offer. What are we talking about over here? We're talking about fixed income as well as equity?
Yeah, so it provides equity, fixed income, and also alternate investment funds opportunities. So basically, equities, everybody in the show must be familiar with. It allows you to invest like a mutual fund. The fund managers can actually decide to buy in top 200 stocks. The rules governing, so technically one gets largely a large cap kind of exposure in equity, which is proven to be having more established powerful businesses which can actually withstand most of the economic cycles. The other aspect of debt is it has two options. Unlike PPF and EPF, which only gives you exposure to government bonds, this also gives you exposure to corporate bonds. So you can choose to invest your money in corporate bond option, and it basically gives you allocation towards India's top rated corporates, AAA rated companies, which actually possibly can give you slightly higher return than government bonds as well. May not be as secure as government bonds, but basically almost equal or slightly lesser than that with a higher interest rate. And third option is as alternate investment funds, which actually is capped at 5%, but it gives you exposure to real estate investment funds, infrastructure investment trusts, mortgage-backed securities, and any kind of securitized debt assets, which actually are giving you higher coupon rate. So all in all, what happens is by packing an equity, debt, an alternate investment fund, you have an option to actually make a portfolio at different risk profiles for yourself and gain more wealth. So there are max limits for different asset classes here. So In equities, one cannot go beyond 75% allocation, and in alternate investment fund, one cannot go beyond 5%. Barring these two, you can actually go 100% government securities or 100% corporate bonds. And to make things simpler, as you mentioned beginning of the show, this becomes too complicated for retail investors to really decide their asset allocation. What PFRDA has done is actually provided different automated investment options like life cycle funds, as they call it. So life cycle funds have three options: aggressive, moderate, and conservative. Aggressive can go up to 75 in equity, moderate can go up to 50, and conservative one can go up to 50 or 20. And what happens is, the good part is, as you go towards retirement, as you age beyond 35, all the three options actually cut down your allocation to equities and secure your portfolio more and more, so that when you're towards retirement, about to retire, most of your money is actually in government bonds and corporate bonds, or any of these two securities, so that you are basically not in for a shock if a downturn in economy comes at that point of time.
So, Santosh, now, given the kind of options you have, how does one select these asset allocation and make an investment strategy as per NPS? Does it differ as per your age group and the kind of time left you have for retirement?
So, Kavita, what happens is, as I mentioned, PFRD has done a wonderful job in making it very simple. It provides you automated portfolios kind of solution, which is called Auto Choice. It has three options available for investors: life, aggressive, moderate, and conservative. And another is Active Choice, where if you are an informed customer or investor, you can say that, let me manage my asset allocation based on market cycles. I'll go more aggressive in equities when markets are cheaper. I would possibly cut down my kind of equity exposure and go towards government bond and corporate bonds when markets are expensive. And what happens if basically money is locked in till 60, so you cannot withdraw the money. But what happens is, you can book your equity profits, transfer to government bonds and corporate bonds, basically buy cheaper equities by transferring money back into equities from corporate bonds and government bonds. So this becomes a bit complicated, or rather more informed investors can do it. I would actually recommend, for large population, the aggressive, moderate, conservative really fits the bill. Why? Because the moment you reach 35 years of age, all these plans, be it aggressive, moderate, and conservative, they start cutting down equity allocation compulsorily. So every few years, your allocation will be cut down a few percentage points, in a way that by the time you reach 55, aggressive life cycle fund will actually act in a way that only 15% of money is equities and rest is in government bonds and corporate bonds. The moderate cuts down to 10 in equities, and conservative cuts down to 5. So what happens is, anyways, if you are an investor, even if informed investor, you would actually act in these kind of ways, where as you grow older, you'll cut down your equity allocation automatically, even if you not opt for these auto choice funds. So I would actually recommend that everybody, depending on one's risk profile, can actually choose between aggressive, moderate, and conservative, and let the fund manager manage the asset allocation and keep it very simple for you. By the time you are about to retire, most of your money is in safe assets.
So the time is already up, but then I want to understand what kind of selections in terms of investment strategies one has in NPS. You're talking about auto choice, you're talking about active choice. If you could just quickly explain us what kind of selections or options are these?
So when you open your tier one account, which actually is a retirement solution under NPS, when you open one, Kavita, you get two kind of choices to make from. One is what kind of asset allocation you want, active or auto, and you can choose to go for auto, move to active, from active move back to auto at your choice. And I think the number of times you can do in a year is about 2 or 4. And you also to choose a fund manager. So there are about 9 fund managers and under NPS, and at any point of time, your money will only be going to one fund manager. So you can, for example, say I want to go with ICICI or HDFC or SBI or LIC, whatever the company you choose from. They will actually be managing your money under their pension fund license. So what happens? You make only two choices in life when you open a retirement account. Choose your asset allocation active or auto. In auto, based on your asset, kind of risk profile, you can choose one of the asset allocation plans and stick with it for long term. And if you believe that you can move to active at some point of time, to basically time your entry at higher, kind of in lower equity prices and things like that, you can do so. And the fund manager, of course, you can change fund manager as well if you're not happy with the performance in a few years from now. So I think it is one of the most flexible retirement solution that a private citizen in the country can actually avail of, and actually secure a very good a monthly income during retirement years for oneself by actually having an annuity plan as well. So all in all, it's a great solution, world's lowest cost, and one of the easiest to buy as well. You can buy it in most of the banks' online websites, ED Money app, and multiple other venues where you can actually easily access it in offline world as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.